Essentially what we're talking about, like I said, it's more big picture stuff today where we are trying to get a handle on a realistic expectation to be able to retire a millionaire. And a millionaire, it's not necessarily some number that people have to hit. It's just a very general, broad way to speak about a successful retirement. So don't think the million, you have to hit 1 million and, more than that. You don't need less than that. If you don't hit your goals, then you've somehow failed. It's not that. It's just that I'm speaking to a general audience. So that's kind of the benchmark number that we're going for. And I've always said that it's actually simple. That's why I said simple, but not easy. It is very simple to retire a millionaire. It is just 3 steps. Number 1, you do want to build up a good income for yourself that covers your life expenses and covers your family if you've got one and whatever hobbies you're going to take part in. This is obviously important. Everything starts from income. So it's not something that we get into a lot within my community, but it is a very big part of the long-term process. Build yourself a good income. Now, obviously, beyond the scope of today's live stream, excuse me, but a few things that you would definitely want if that's what you're trying to do is build your income up. Obviously, you'd want to be choosing something that you are somewhat interested in and that you are somewhat good at, or at least are trying to pursue being better at it, because that's going to help with the motivation and determination to keep going. The average income in the United States, the median individual personal income, is about $36,000. I believe I pulled that up somewhere here. Real median personal income in the United States, $35,800. So this is essentially the average income. Now, if you're trying to be better than average, you are going to have to work harder. There's no way of getting around that. So working harder and getting motivated and disciplined is much easier if you're interested in the subject and you can actually stay motivated. So that would obviously be a very good step 1 to get yourself a nice income. Step 2, also extremely important. We talk about budgeting and little tips here and there a little bit in the VTS community, but again, we are mostly talking about investing. But obviously, you are going to want to live below your means and save as much money as you can. Now, again, this is a problem with the social media age that we are all encountering in the last decade or decade and a half, and it's getting worse every year, is that we are living in an age of essentially ultra materialism. Their marketing is just directed at us and making us all feel inadequate if we are not keeping up with everybody else and showing these fancy lifestyles. And it's becoming more and more difficult for people to manage their own budget because of all the influence from outsiders, which, as we know, if you really dug into that, a lot of that is just fake, but it's in our face constantly. So it's very difficult these days to keep that budget in line. But as I will go through with the actual numbers, it is very, very important for people to be adding money to their trading account every month so that 30, 40 years later, you can easily reach your goals. And then the third thing, which of course I help people do, is you need to invest wisely. And this is where that 12% number comes in. So why do I say 12%? Why am I not one of these people that's going out saying, hey, we're going to make 40% or come to the community, I'll double your money in a year? I mean, of course, it's just not possible. That's not how investing works. And it will lead to spectacular failure if people chase performance like that. But it is not necessary, and that's what we want to talk about today. So follow-up questions to a recent article that I did talking about this 12% number. Essentially, why do I say that that is a good target? This is something that I hear all the time when I mention this is, that sounds awful low compared to what I'm hearing online. And very true. You are hearing a lot of people essentially lying about rates of return. Yes, it's very low. It sounds low. If it's not 40% a year, I don't want it, basically. But is 12% a year really enough to retire on? So one of the benchmarks that I have showed recently, that I talk about recently, is this 1% a month number. That's that red line on our performance chart. I don't post it often. People are more interested in the Vanguard VBanks, a 60/40 stock bond index fund. So that's the one that we benchmark our performance against. But it is worth noting that there is a 1% a month target number that I do believe long-term is a better number to look at. Because as we know, the S&P is on an 11-year run. It's been very good. The Vanguard VBanks is fine. But at some point, both of those are going to spectacularly crash. Right? I'm not predicting when, I'm not a doom and gloom type person, but at some point, they're going to drop substantially. And they will have a very difficult time keeping pace with even a mid to low single digit run. I'll get into some numbers in a second, but I did a live stream recently as well, if you are interested, that was talking about this. I basically made my case, and I'm going to do one for bonds as well, but the one we did for stocks is, where are you there? This one, the one that says retirement crisis, stocks are doomed. I essentially made a case that going forward, the S&P 500 will have a very difficult time even making a 5% rate of return. So go ahead and check that video out if you are interested. But essentially, that's what we are talking about here. We are wondering, is that actually enough? Is 12% a year really enough? So what we are looking at here is a retirement calculator, just a very simple retirement calculator with only the inputs that we need. And we're assuming that somebody starts with $500, right? Say you're 30 years old, you've got $500 in your pocket, you're going to put it into a trading account, and you're going to get started on building your future. There's that 12% a year number. I know it seems low. For some people, that might seem high if you actually understand hedge fund results, financial advisors, asset managers, what the actual rate of return is. It's substantially lower than that, as you probably know. So that might sound high to you, and that's great. I hope it does. But for a lot of you listening, you're going to think, oh, 12%, that's nothing. We're just going to go with it. 25% capital gains tax. If you do this within a tax-sheltered account, of course, you can get that to zero, at least deferred until your retirement. But I just like to use the low ball assumptions, so we're going to use a capital gains tax there. Monthly addition of $500. This might sound low or high to you, depending on your situation. Hopefully it sounds low, but yes, $500 for a lot of people is going to be difficult. And again, I'll get into a few statistics about that later on. 2% annual wage growth is about in line with history. It's actually a little bit higher, but I'm also going to inflation adjust everything. So when I say you will retire a millionaire, I mean an actual millionaire, not just a nominal millionaire. And then the inflation rate's going to be crazy and $1 million will feel like 50,000 or something. I mean, we could be facing hyperinflation or at the very least rising inflation, and wage growth has not stayed pace. So I'm just going to zero it out and have a 0% real wage growth. I think that's realistic going forward. And then here's the results of that. So it may be surprising to some of you. I don't know if you've all used retirement calculators like this, but simply put, this person, if they start at age 30, by age 70, which is an average retirement age, they have basically $1.7 million with a 12% rate of return and adding $500 a month. So this is essentially why I say in the intro there, this is why I was saying that most people can achieve this. Now, I understand it's going to come with sacrifices, and we'll get into it. 12% a year is not as easy as it sounds, maybe, but this is achievable for people. Retiring a millionaire, even if you are on that US median income of $36,000 a year, if you're somewhere in that range, $500 a month would require decent savings and very, very diligent planning of your budget, but it can be done. And while it's not easy to get a 12% rate of return, it also can be done. I don't like to flash things that are unrealistic but it, our unleveraged portfolio, maybe somewhere up here, leveraged portfolio, it can be done. In my personal opinion, it must be done through risk management, must be done through drawdown reduction. It cannot be done by chasing performance and shooting for big gains. That's not the way to develop a long-term rate of return. But this can all be achieved. So let me go back to my screen share. So now that we know that it can be done, what if we just make a few different comparisons? Because maybe 12%, like I said, sounds high, sounds low, depending on who you are and where you're from, what you're doing. But let's just make some basic adjustments. So the second calculator here, 12%, let's go $500. So this is now the same, right? The comparison is exactly online. The only difference we're going to change here now is let's do something that is half that, a little bit more in line with what the asset management world, the real financial industry, is actually achieving long term. And we've got something that is significantly less. So still over $500,000 though. So obviously that $500 a month that is being added to the account is definitely still important. But the good news is, if we also do the adjustment the other way, maybe add 6%, now all of a sudden we are looking at somebody who can retire very comfortably. Actually, the number equals, at that sort of average retirement age of 70 years old, oh, sorry, wrong one, it will equal probably about $6 million or something around that level. So yeah, exactly $6 million, inflation adjusted, which obviously good news. If you are that type of person that can be a very effective investor and make 12, 13, maybe 16 or 18% a year, then all of a sudden you're going to be in a very, very good position. So this kind of leads and begs the question a little bit. Why are so few people actually achieving this? It doesn't sound that difficult, does it? A 12% rate of return sounds low for a lot of people. And $500 a month, not easy, but most people can save $500 a month if you just control your budget. So why is it that in the United States, there is only 8% of adults who are actually millionaires, net worth of over $1 million? And side note there, the average age of people in that millionaire category is 63 years old. And roughly 40% of people who are net worth millionaires in the United States don't achieve that until 68 to 70 years old, right in that retirement age, right? It takes a very, very long time. I know we're in the social media age where everybody's making these big promises. You'll get there this year, next year. We're just going to the moon with everything, right? Everything's in a bubble, obviously, including online gurus. But it is a very long process. But why is it that if it's so easy and if the numbers are so simple here, why is it that so few people actually achieve that? Well, the first reason is, like I sort of been touching on, they don't actually make 12% a year. So that's where I was getting at with where I was pointing out the retirement crisis. People aren't making 12% a year. And this is where it gets into the realistic expectations part. Because if we just look at the hedge fund or the HFRI hedge fund index, for example, just as a broad benchmark, 10-year annualized 5.71%. This doesn't include the financial crisis. So, of course, it's going to be substantially less than that if we drag it back 15 or 20 years. But low single digits. Got an S&P 500 calculator here. The S&P is essentially one of the highest performing benchmarks that you can have out there. And we're just going to completely arbitrarily choose 20 years. We're going to adjust this for inflation. You can see 5.07% over the last 20 years. Now, this isn't a very good gauge because actually November 2001, while it's not a low, it's not an ultimate low, it's actually a fairly low period going to an ultra high period, going to an all-time high from a low. It would be more accurate to gauge it somewhere from, say, May 2000, high to high, or you could go bottom in 2001 to around the pandemic bottom. You don't want to go from a fairly low point to an ultra high point. It skews the numbers a little bit. But even the S&P 500 is looking at what it actually achieved, 3 to 5% in the last 25 years. What I suspect it's going to do going forward, because remember, we are measuring from now, from an all-time high, for the next 20 years, I suspect it'll be low single digits. So that is one of the things that makes this, I'm trying to present it as this is achievable for everybody, but the truth is, not very many people will make that 12% a year. This isn't an advertisement for what I do in any way. My live streams are free. We don't really talk about the community too much unless we have to, but there are ways to do it, but just know that actually in the reality of the financial industry, that is something that is just quite rare. And then when you factor in the fact that nobody actually puts all their money in the stock market anyway, so you've got to include a healthy portion of maybe bonds, fixed income. Those are going to be substantially lower than 5%. Obviously, with interest rates where they are, it's going to be a nightmare. You've got Other things like real estate, bubble, all-time highs, starting today, going forward the next 20 years, not anticipating a very good run there either. So unfortunately, most people are looking at a low single digit, but that 12% a year is starting to look like a better and better target for a lot of people to look into. The second thing is they don't save enough or any. And why I say or any, as we know, depending on which studies you're looking at, but in the United States, roughly half of the people are living paycheck to paycheck, right? Not saving any money. And this, incomes are low, wages are stagnating, inflation's going up, but wages are not matching. But also, you've got a situation where social media is not forcing, but certainly coercing people into just spending too much money. People are not saving as much as they used to. The savings rate as well has dropped recently. Now, obviously, very recently, because of all the stimmy checks and whatnot, we've seen some wild action there. But you can see, from 1960 to about the mid 90s, it was 10% or more. This is the personal savings rate. And then, the 90s, the early 2000s hit, and now all of a sudden in the United States, it really never gets back to 10%. It's more sort of bouncing around between about 3 and 8 or 9%. Let's say an average of 5% personal savings rate. And I would imagine, given the influences of social media and the somewhat materialistic nature of the world we live in these days, I would imagine the savings rate is going to be pretty dismal going forward. So one way that you can get ahead very quickly is you can just save more money. You can just not participate in that materialism, that consumerism. Now, obviously, you need to buy certain things. You need to enjoy your life a little bit. I'm a minimalist, but I'm what I call a stuff minimalist. I'm not a financial minimalist. I don't do things in my life to save every penny like some minimalists do. I reduce my stuff to the least possible amount. So while I can fit all my belongings in my life in 2 or 3 suitcases, when I need a new computer, I get a good one. When I go on a vacation, I go on a nice vacation. When I have a vehicle, I have a nice vehicle. But I have very, very few stuff. I'm not a consumer. I'm not materialistic. I'm not into that world. And I would suggest people try. I know it's difficult. It's in our face constantly, 24/7. But try to save more money. But this is another reason why people don't do it. So if we look back at this calculator and we make a few comparisons, first of all, we'll return to the 12 and the 500. The first thing I said, people don't make 12%. Well, what if they just make 5? All of a sudden, if you're investing with, a run-of-the-mill financial advisor, or your money's in hedge funds, or you're trying to do some 60-40 balance fund, that's going to be low single-digit return. It's going to be 5% or less, and now all of a sudden it's going to be around that 500,000 mark. Still something, but not nearly what we are trying to target today. The second point that I made is that people actually don't save very much money. So what happens instead of 150, or 500, you do 150, right? Now you're only saving 150 a month, which isn't that out of line, to be honest. The median income is 36,000, and the average savings is, let's say, 5%. Saving $150 is actually in line with the average of what people do. $150 is a decent amount of savings. But again, that's going to lead to a substantially lower number down the road. That's another reason why people don't hit their goal. And the third one, of course, time is a very strong ally in compounding. And so if we go to this again, reset back to the original, 500, even if you do make 12% a year, and even if you do deposit $500 a month into your account, you're a good saver. If, for example, you started late and you only have 25 years, well, now you're at that same 500,000 mark. And this is typically where people find themselves, is some combination of the three, or a combination, or all of them at the same time. There are some people who are in that situation where all three of them are hitting them. So very small differences can lead to very big numbers. 12% a year, saving $500 a month for 40 years, which is a normal investing time horizon for most people. Typically, people start around 30 or At least I say they should. And they will retire around 70, as we say they should. That's the first group of people. The second group of people are going to make substantially less. They're going to save substantially less. And they're only going to have 25 years to do it. Now, all of a sudden, this person is at about 100. Well, they're at $74,000. I think I've prepared this slide wrong. $75,000 inflation adjusted. So small changes can actually make a pretty big difference to the long-term expected outcomes here. We've got one person who's going to retire in total comfort and financial freedom with relatively not easy, but simple sounding input variables. And then we've got another person who didn't even achieve those things, which is the average person out there. We've got a very, very different situation depending on where people fall. So I suppose the overall point here, number one, I really do like to constantly dispel this myth that somehow making massive outsized profit is normal or acceptable. It is absolutely not normal. As we know, roughly 80-85% of asset managers don't even outperform their benchmark. And those benchmarks they're comparing against are typically in the mid-single digits. And like I said, going forward, it's going to be even less than that. So not achievable. And then not real as well. I mean, everything that we see online, you really have to understand that there is a reason why there's no performance ever shown. There's no real clients. Every time somebody's talking that way and they try to launch some type of service or business to try to sell those signals in those chat forums, what happens to those people? What happens to those people that are lying online, talking about how they make 100% a year? Well, the second they start collecting money from real paying subscribers or clients, you essentially start the stopwatch on the end of their career. Because obviously, if you lie, immediately people are going to realize that they're not getting the return that you were talking about. You built up your community for a year or 2 years telling all these exorbitant lies about how rich you are. And then all of a sudden, real people start following it and you're making nothing or a very low rate of return. The excuses start coming in. So what do we see with these communities that talk about those big gains? Well, it's not more than a month or two before you go on Twitter and there's all kinds of people in the comment section telling everybody that it's not real, that, oh, you said this and you said that trade and you didn't take that trade and I read your email and you didn't say that. It's a nightmare. The comment sections in these communities is just a dumpster fire. And the reason that's happening is because it's lies. Now, I don't want to always bring it back to me. I really try not to do that. But I've been doing this for 10 years. There's never anybody saying anything negative about me. I talk about realistic rates of return. I show my real performance, completely transparent, and it's not always good. And there are times when it feels like, wow, look at all these people making 50% a year, and this guy's not doing that. That's what it must feel like. But of course, I've never blocked anybody. I've never had any issues with anybody complaining because realistic long-term rates of return is what we talk about in my community. Mitigating risk, reducing drawdowns, being very consistent and stable, and understanding that this is a long, difficult process. Multiple decades, not just where are we going to be next year. This is where are we going to be in 2038? That's the type of mindset that you need to succeed in this world. And so, a lot of people ask me, well, hey, if it's so simple, how come everybody's not a millionaire? Well, everybody's not a millionaire because they get derailed at certain stages along the way. And it is my job not only to achieve the good rate of return and to deliver on my promise of that, but also to remind people and to be there to talk about investing philosophy and big picture stuff, macro stuff. Let's step back 30,000 feet and really discuss these things. I like to talk about psychology a lot, investor psychology, and I like to make sure that people understand where they're at in the process And every time they kind of try to get derailed a little bit by all the noise out there, I would like to try to do my best to bring people back to that realistic expectations. Now, obviously, I have made far more than 12% a year since we launched my business, and I do plan to continue that. So I'm not saying that it's, that's all we're targeting, but don't scoff at 12% a year. Don't be one of those people that falls for those lies out there. Join their community if you have to. If you see somebody talking about 100% a year, they're talking about how it's just like it's an ATM machine and, just easy cheddar falling from the sky, join. Watch how quickly you don't get that in your trading account. If you have to go through the process, go through the process. But there are virtually no legitimate asset managers that I follow on Twitter that talk that way. Literally none of them. Why? Because we all manage real capital. We all have real human beings following what we do. Personally, if I'm out there talking about how I'm a volatility trader and I make 50% a year, it will take 1 month before my entire community realizes that I'm a liar. It doesn't work that way. So 12% a year, you can become a millionaire. You really can. If you've got time on your side, you've got that rate of return, and we block out the consumerism and the materialism, have a little bit of delayed gratification with the purchases that we're making, you can all do it. You really, really can. That is my job, not only to do the investing, but to encourage everybody out there that if you structure your life correctly, even if you are one of those people, and I would always encourage people to focus on hard work and determination and to try to get out of that situation, try to get as high as you can, because everything starts with income. But even if you are one of those people that are, bouncing around the median, 35, 36,000, you can still do it too. Don't think that becoming a millionaire is just for the privileged people or the lucky people or that. Sometimes it's just people who have prudent planning and effective investing. Growing up, when I was a kid, I won't name any names, but I had a group of friends, let's say 10 close friends, and I would say most of them had parents who were above the median income. But I remember one of my friends in particular, let me try to get this straight. Father was a teacher, just an elementary, maybe junior high school teacher. Mom was a nurse, not a master's nurse, just a teacher and a nurse. And honestly, I think that as time went on and I started watching and I grew up and we went to university and I started noticing things, I honestly think, I would guess, they easily retired millionaires. I would imagine that family, I had friends, my family was fairly middle class, but I had friends who their parents made a ton of money and always seemed to have financial difficulty. But there are people out there who, on a fairly modest income, if you make good decisions, invest wisely, it is actually achievable. And I guarantee that family, not that my friends are watching this, I don't have to dance around it, but I would imagine that they are comfortably retiring millionaires. So good to see. It's nice to see that it's not just for the rich. It's not just for the doctors and lawyers. Everybody out there, you can all do it. So there are some pitfalls out there, so minefield, and you might want to avoid Twitter, especially. You really want to be careful who you're following on that platform because it's an absolute nightmare. And you can see it. You can see it in the comments. You can see it in the engagements. You can see it in it falls apart very, very quickly. So you won't ever see me talk that way. I'm always about realistic expectations and long-term success. It's virtually guaranteed. If you have a very good plan, if you're a good investor, and you allow the process to play out, it's almost guaranteed.